The consumer is spending less. We've seen global import from the US collapsing. We've seen global export from China, as just mentioned, has been collapsing. We see the year-over-year retail foot traffic collapsing. We see that and that's probably the most important part, if we look at the actual cost of capital to spend, which of course is in the category of cars, is in the credit cards segment and in the mortgages, we are talking about all-time highs, and we are at an average about 1.5, 2 times the normal rate of financing your spending, which of course is an American holiday to do on any specific time they want to spend money. So the concept here is really that the data we have incoming in terms of inflation is acyclical. And what we're seeing right now is that this rolling recession that is probably ongoing is moving now from manufacturing into the consumer spending.
Just before I move on, and by the way, I love the air traffic controller look, so it was a compliment indeed. The US 10-year Treasury yield is rising to a 9-month high of 4.22 at the moment as well, just to endorse what we were just saying about rates and that as well. Look, in terms of the market appreciation of everything you just meant as well, are we in a sweet spot, or actually should our viewers be a little bit circumspect about the levels we're trading at, Steen?
It's extremely expensive by any measure, obviously, both historically and in terms of sort of intrinsically what you can expect from returns when you're at this elevated level. I've sort of risked a little bit by saying I think we're going into stagflation, and I think there is a 1 in 3 chance that by Q4, probably the end of Q4, we'll probably see Fed cutting interest rate. And here I may add that you're talking about the liquidity concerns here, because right now as we talk, of course, we see, and everyone is focused on that, the issues from the U.S. But at the same time, we've seen recently that the reverse repo has started to come up in outstanding size, and at the same time, the treasury account is also unchanged. So in other words, we're actually seeing right now that the sort of handover from the money market to the treasury market is not happening, which of course is putting additional pressure on the upside. So if anything, over the next 1 to 2 months, we'll probably see a retest of the high in yield. And as we see that yield, we also see the performance that we've seen so far months to date, that the energy, green transformation, bubble stock, gaming, biotech, semiconductors, payments, all of these normal favorites are under some pressure in equity terms.
Steen, I want to get you to some of the breaking news this morning around the UK, and we've just seen the pressure still coming through on the wages component, the 8.2% increase in average weekly earnings, this higher than the 7.3% anticipated in the 3 months to June this year. What do you make of the implications for the Bank of England from here?
That they will continue to be rhetorically very, very hawkish. But I think the peak rate in the UK is already in. I think, as I just stated, to the global economy and the US economy in particular, what is going on right now, of course, is that wages is lagging the overall economy. We're talking about economy which in terms of the housing market is slowing down, in terms of the consumer spending is slowing down. And it's only a matter of time before everyone will be transparently seeing that the U.S. economy needs lower rates, not higher rates, to actually get the economy going again. So we are sort of at a catch-22 that Bank of England needs to hike. They shouldn't do it. They will probably try to navigate that. And on the other side, we've seen the economy continues to weaken overall, despite the relatively good numbers this morning.